Hi, everybody. This is Josh Jelinski, the financial quarterback, and we have special guest Caleb Silver, editor-in-chief of Investopedia.com. Caleb is frequently featured as a markets, economic, and consumer trends expert on MSNBC, NBC, ABC Radio, Cheddar, and numerous other daily newsletters. So, Caleb, for those of our listeners who maybe have never been to Investopedia.com, describe what you do for Investopedia and how big is Investopedia now?
Well, thanks for having me. It's a pleasure to be with you. I really appreciate it. We are 23 years old, and in internet years, in real life, that's 230 years, but 23 years in the internet is a long time. And our mission has been, since the start, helping investors learn how to use money, how to invest, how to understand your money, how to understand your budget, how to put money to work, how to pass it on, how to trade. So we're really about investor education. And I think we're one of the biggest resources for that on the internet. We have about, over 23 million people around the world who come to our site every single month to continue to learn. And people find us through search engines or they come directly to us. But we've been here a while, and I learned how to become a business journalist using Investopedia. So it's just an honor to be the editor-in-chief today.
Yeah, Investopedia is a great resource. So what's new at Investopedia? I mean, you go on there, and it used to be, it seems like you're getting deeper and deeper into the weeds. So there's a lot. It's almost like a better resource every year. Anything new at Investopedia or fun things that maybe the average person doesn't know about?
Yeah, the average person discovers us because they're searching for something. They have intent. They want to learn how to do something, and they want to learn what something means. But inside the site, which is pretty robust, we have a paper trading platform, a stock simulator where people can learn how to trade. They can learn how to use options. They can learn how to buy ETFs, and even crypto is coming very soon. So we have that. We've also leaned heavily, not heavily, but somewhat into news in the past few years because there's been so much going on. So it's one thing to have the dictionary. It's another thing to provide that modern day context to what's going on. So we spend a lot of time updating a lot of our older articles and definitions and terms, but also creating some new ones because the dynamics around money, how we save, how we invest, how we earn it, what money actually is today in 2021, that's always changing. So we continue to add parts to our site. And then we do a fair amount of helping our readers pick the right products, whether that's an investing platform or whether that's software for tax accounting or whether they're looking for life insurance. We do a lot of editorial reviews of products that investors use and that modern day consumers use to help them make the best choices. Because at the end of the day, people are coming to us to solve a problem, and we want to make sure we have the best answers for them.
And we're talking to Caleb Silver, editor-in-chief of Investopedia. So Caleb, describe your background. What brought you in the world of financial planning? And, you said business journalism. So describe kind of your origin story.
Yeah, I'm an accidental business journalist, but here I am 26, 27 years later. I started my career in the restaurant business in Santa Fe, New Mexico, where I grew up, and I love the restaurant industry, even though it's one of the tougher ones out there. But I did learn how small businesses work, running restaurants and being a cook and a waiter and a manager. So I started there, but then I became a documentary filmmaker, focusing on environmental educational documentaries, doing a lot of wildlife documentaries out in New Mexico and around the world. That ultimately led me to journalism school here in New York, where I interned for Bloomberg in the late 90s. And if you remember, you may be too young to remember, but those of us that were around remember a pretty fat internet bubble back then. So I started covering that for Bloomberg as an intern and then later on as a producer. And I really started as a business journalist back in the heat of the battle in the late 90s, and I haven't left since. Went from Bloomberg after about 8 years to CNN, worked there for 10 years, helped launch the Situation Room with Wolf Blitzer, ran the business news desk, ran the assignment desk, worked on a couple of shows, and ultimately was the director of business news for CNN. And then I went back to my documentary making for a couple of years, but then I saw this opening at Investopedia, which is a resource, as I said, that I've been coming to basically my whole career, and realized that there was an opportunity there to really help a lot of people at scale understand investing, understand money, understand wealth creation, and understand really how to navigate their way around money. And I found that to be super rewarding, and I've been here about 6+ years, and it's just been a rocket ship ever since.
Wonderful. So what about who owns Investopedia now?
We are part of the Dotdash family of websites. Dotdash, you may remember as About.com. About.com was acquired by our grandparent company, which is Interactive Corp, IAC. They own us. They own Investopedia and Dotdash. And we were acquired into the Dotdash family a couple of years ago. So we're part of that unit. And if you look inside IAC's holdings, you'll find Vimeo's in there, Angie's List, and a big company called Dotdash, and another company called Care.com. Well, we're part of that crew inside the IAC public company, but really our parent company is called Dotdash, and you can find 13 different websites that we own and operate across various verticals.
No, that's fantastic. So we're with Caleb Silver, editor-in-chief of Investopedia. So you mentioned documentaries. Would we know any documentaries that you created?
I did several in partnership with Starfish Media for CNN and for PBS and for various networks. And also I did a bunch of wildlife documentaries as well, and did some work with Amnesty International. That was years ago. I just produced a short feature film, a little horror film that's going out to festivals right now. But a lot of my work's been on cable in terms of television, and I've been in business news and news for a very long time. So there's lots of programming out there, but the documentaries, you haven't seen them at the Academy Awards. Not yet, but they're coming.
Yeah, I think I probably watched some of them. I got to get your list of documentaries. So that's exciting. I like documentaries. I enjoyed them as a kid. And I have a daughter. She's 13. All she does is watch documentaries.
What a great way to learn.
Fantastic. So we're talking about crypto with you and the cryptocurrency boom. You mentioned that you came of age sort of in the dot-com bubble, which then became the dot bombs. Do you find any parallels between the late... I think if we are to... Everybody's worried about having another 2008, right? Like, you talk to people have been worried about having another 2008, well, since 2008. We're going to have, remember the double dip recession of 2010 everybody was worried about? Then it seems like every so many years we're worried about another 2008. But as I've studied the markets, I think this period in history has more in parallel to the late 90s than it did 08. What say you about that? I'm worried about that.
Yeah, I mean, 2008 was a liquidity crisis. People overextended in mortgages. Banks too eager to loan to people that didn't have good enough credit, and the whole entire financial system propped up on these risky bets. Very different from when you have a mania of investors or a rush of investors rushing into asset classes. And you're right, 99, 98, 99, .com bubble, pets.com, the flagship, of that era. But when we have a lot of investors and new investors rushing into asset classes and bidding them higher without a kind of a fundamental understanding or actual care about how a lot of them work, you're going to get manias and bubbles like this. And I believe in the future of cryptocurrency. I'm not saying it's not going to be here. I believe in 10 years, we're going to be talking about Bitcoin. We're going to be talking about cryptocurrencies and operating through digital wallets and on the blockchain. So I'm a believer. That said, the rise in the asset prices of the tokens and a lot of the other derivatives of those, that's pretty intense. And that does remind me a lot of 1999 as well. And you have so many new people who are doing it, but also the technology, Josh, is so much easier to access the markets for anybody with a smartphone. Get a Robinhood or another type of trading account. There's zero commissions on trades. You can buy fractional trades right now. You can do all kinds of obscure types of trading just from your smartphone without a lot of knowledge on it. It's opened up and it's changed. The game has changed substantially.
So on the whole crypto thing, are you a Bitcoin maximalist or do you see the others as having some opportunity as well?
I see opportunities for various types of tokens and various types of cryptocurrencies riding on the blockchain or something like it. I believe that we'll be talking about Bitcoin for years to come because institutions have now adopted it. When Fidelity and the Schwabs of the world and JP Morgan Chase and Goldman Sachs are starting to make it available to their clients or at least talking about it, it's mainstream. When Visa and MasterCard are giving you rewards in crypto and Bitcoin, it's mainstream. When you can buy a Bitcoin-related ETF, mainstream, and we know a lot of those are coming. So I believe Bitcoin is here to stay. Will it be the king coin a decade from now? It's really hard to say, but it's got a lot of the market cap and a lot of the attention right now. But if you look at some of the other ones, there's some real practical uses for some stable coins. There's practical uses for Ether. When you look at what the financial services might look like in 5 to 10 years and what it's going to be running on. So you can see if you've been studying the markets and the way money works for as long as I have, you can see how this could work. But it's hard to say which coin will end up on top. There's not going to be one ring to rule them all like there is in Lord of the Rings. I think there'll be a few coins. And then the U.S., the Federal Reserve, or the Treasury Department here, they're going to probably issue some sort of a digital coin in the near future or in the next few years.
Fantastic. Folks, we'll be back after these messages with Caleb Silver of Investopedia.com. And during the break, give us a call at 888-988-JOSH, 888-988-5674 for the free 45-minute no-obligation review, 888-988-JOSH. We'll be back after these messages. And we're back with Caleb Silver of Investopedia.com. So we're talking cryptocurrencies, and there's obviously a lot of cryptocurrencies out there and so many scams. Can you talk about the ones you trust versus the ones we should avoid?
Yeah, I only trust the ones that have worked so far for me. So like a lot of people, I have an account on one of these, public exchanges where you can get your own cryptocurrency wallet. I have that verified. So I've been playing it pretty safe there. But there are a lot of new coins out there that don't have a lot of backing, that have a lot of hype behind them. That's the fastest way. It's not necessarily to get scammed, but it's the fast way to lose money if you don't understand what's going on, because there's very few people, and this applies to Bitcoin as well, that really own the majority of those coins. They're called whales. And if you look up and down the token universe, you're going to find that whales control most of the market share of all those coins. So they move in any direction and they take the market with them. It's very different from, let's say, the New York Stock Exchange, where you have a lot of market participants, right? These are tightly controlled, even though they're widely available. So you got to watch out for that. And you got to watch out for offers for cold storage or free storage. You got to really understand how to store your cryptocurrency, how that works, and make sure you're double verified, password protected, but you don't lose that password. You don't lose those keys, because we've heard so many stories about people forgetting their password, forgetting their keys, and not being able to access their cryptocurrency. That's a real thing. But you also have exchanges popping up all over the world that may not have the type of regulation, and not that we have much regulation here, but there are some rules you got to play by where you could easily lose all your money very quickly. So you got to research very, very thoroughly what you're about to do if you're going to get into cryptocurrency. That said, you can go on to Coinbase right now, start an account. That money will be in there. You're going to fund it with something from your checking account. It'll be there tomorrow. I feel like that'll be around for a while, but I wouldn't risk, and by any means, more than 5% of your portfolio in cryptocurrencies, even if it was totally safe.
So as it relates to the wallets and everything, what about losing your cryptocurrencies? How does one protect themselves from I spoke to a guy today. He lost 2 Bitcoin when he started. So he lost the equivalent of 120 grand today. How do you protect yourself from losing your Bitcoin or losing your ETH?
Yeah. Well, the thing about the blockchain is that the entire premise of it is to have a decentralized place where you can have a digital signature of authenticity that makes things uniquely yours. And then when you buy a cryptocurrency and you open a wallet, whether it's on an exchange or in a company like a Coinbase, or if you're buying it through a separate wallet, there is a very particular digital identification number that is yours and yours alone, non-duplicative. And only you can access that. So you can't lose that. You got to make sure that's in the right place, just like you can't lose your vehicle registration. Make sure you know where that is, and make sure you're keeping track of it, even if you're not buying continually or trading cryptocurrencies. And we don't recommend people trade too heavily, but even if you're not that active in terms of the buying and selling of other tokens, check in like you would check in on your bank account. Make sure your password's working. Make sure the money you think is in there is still in there. Make sure you've been realizing the gains or the losses that are happening in your account. So I would treat it very much like a bank account. How often do you check your app on your phone to see what your balance is, or call your bank to see what you got in there, or if a check went through? I would treat your cryptocurrency wallet very similar to that, because you can lose that digital signature, you can lose your identification, and there's really nobody out there to help you. There's no FDIC coming to the rescue in crypto land.
Yeah, so I do think that'll be a way for people to innovate in the future, like people who could help recover lost Bitcoin. But, I guess that'll be an innovation that maybe will come. I could see
That's Blade Runner 2050 right there, my friend.
What's up?
That's like Blade Runner 2050. People coming to rescue your Bitcoin or your cryptocurrencies. They're going to be like detectives.
Yeah. And there'll be experts in chain analysis. It's a whole other world for people. They don't even, people don't understand really where this is all going. So what are your top 5 most trusted cryptocurrencies?
Hard to say, but I buy the ones that are most widely traded. So if you look at my portfolio, you're going to find some Bitcoin, some Ether, some Litecoin. I've explored some other coins, not to the degree that I understand those. I like to buy what I know. In terms of trustworthiness, that's a tricky one. We just surveyed our readers at Investopedia because we have so many who are interested in cryptocurrencies about what they thought was the riskiest of the coins. And you wouldn't be surprised to find the Shiba Inu coin up there at the top of the list. That's only gone up, tens of thousands of percents in just a very short time. There's nothing behind that coin. It's kind of a joke, but that's what's happening in crypto land. They also thought that Dogecoin was pretty risky, and we've seen that Dogecoin can be pretty volatile. Again, nothing backing Dogecoin. There's no asset underlying it. There's no asset underlying Bitcoin. All there is mass adoption. But a lot of these coins that are sort of memey in respect, in that they're talked about widely on the online forums and in financial Twitter, that come out of nowhere, you got to be circumspect of those, and only because, again, they're controlled by a very small group of people who can manipulate the price any which way they want, and there is no transparency for investors to find out what's happening, who's moving that money. You just know that the price went up or down, and there's not a lot you can do about it. Again, no fundamentals there. So all cryptocurrencies have risk to a certain degree, but if you're looking to buy one that most people own and maybe join the wisdom of the crowds, well, you're going to find the biggest ones out there are Bitcoin, Ethereum, Litecoin, Tether's out there as well. I know that has issues. Cardano's out there, Solana. There's so many coins. You can just look them up on Investopedia, the top 10 cryptocurrencies, and we have a pretty up-to-date running list of them. So
you talked about memes, and memes have overtaken crypto. They've overtaken the stock revolution that has transformed Wall Street. How has the meme stock revolution transformed traditional Wall Street? It's almost unrecognizable.
Well, we're talking about stocks. When we're talking about meme stocks, we're talking about stocks that have been highly shorted, sometimes by Wall Street, in quotes, institutions or big investors that take positions betting on that the stock will go down. What we've seen in the past 14, 15 months is this very active group of day traders who don't want that to happen, and either because they want to rescue the company, I would doubt that that's really what they want, or they want to stick their finger in the eye of the institutions that are betting against these stocks. They feel, a lot of these new retail investors, they call themselves apes. They're proud to call themselves apes. They think they swarm into stocks like Planet of the Apes. They think that these institutions have insider information, or they've been beating down these stocks for their own purposes to make money on the short sale. So they're coming in to buy them and prop them up, right? So now that you have this very active investor base with technology on their phone or on their laptops or on their tablets, with no fees to trade, right? There's no more trading fees anymore, and you can buy fractional shares of companies. So at $5 will buy you a piece of Amazon if you want it. They can swarm in with the power of social media and these online forums and push a stock higher, and they can take it down too. But mostly they've been driving stocks higher. Now, there's always been retail investors. Since the dawn of time, since tulip mania in the 17th century, there was retail investors who could do this. But now they have this aggregation and this force, and they can communicate through the power of social media and these online forums and move a stock instantly and cause tens of hundreds of millions of dollars of losses for other institutions that were betting against the stock. That's different. We had these types of day traders in 99, right, in 2000, but it wasn't this amount of people, and they didn't have the facility to trade and move markets the way they can today. But take a look at GameStop. Stock was up some 20% this week. AMC, the theater chain, there's not a lot of people back in theaters. That stock was up some 40% this week, right? Just this week, these stocks are up over 1,000% in the past 12 months. So when you see that type of thing happening, you know that that's not happening from classic institutional investors.
Yeah, Avis Budget. What happened with them this week, right? I mean, talk about that for our listeners who maybe were asleep at the wheel while Avis doubled in a day.
Right. Or Bed Bath & Beyond reported good earnings. Stock was up 80% after hours. Now, is that normal? It takes Bed Bath & Beyond 10 years to go up 80%. So that happens in a day. It's just different. Times are different, and this active trader base can really move the market.
Are there talks about regulating these apes who are kind of, manipulating the market?
On the contrary, they're not doing anything illegal. They're trading stocks, and the market is open. The market's open, from 9:30 in the morning to 4 p.m., but it's also open after hours and before the market actually opens in the morning. So they're taking advantage of that, and they're taking advantage of the fact that they can access the markets like never before. There's nothing illegal on the surface happening there. What could be illegal is the spread of disinformation and misinformation or inside information. What could be illegal is what I think that a lot of folks are looking at is their manipulation going on inside some of the companies that may be leaking information that is setting these traders off on a buying spree, or is there information being leaked on the sell side, on the institutional side, to set these traders off onto a buying spree? That's the type of thing that could be illegal. But you, me, or any of the folks who call themselves apes or active day traders, if you're playing by the rules and using a brokerage, you're playing by the rules. You're taking risks, but you're not breaking any laws.
Fascinating. Well, we'll be back with Caleb Silver of Investopedia.com in a moment. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jelinski, the financial quarterback. We are with Caleb Silver of Investopedia.com. And we were talking about the Avis Budget Group's really insane week. But what I mean by manipulation is, it seems like these traders are looking at, what companies' hedge funds are shorting, and they're just going after certain institutional funds. The greedy people shorting stocks, it's like a Robin Hood kind of take from the rich to give to the poor mentality. You just wonder, how long that will go on before there'll be some type of, Martha Stewart goes to jail for her insider information. It's not insider information. It's publicly available knowledge. But it seems like all they're doing is just looking to see which stocks are being shorted by which institution, and they're almost making a bet against a particular fund. Any research you've done on that, light you could shed on that?
Yeah, and I think they would tell you that these institutions can bring down a stock if they want to, just because they want to, or they find an easy way to make some quick money out of it. And this whole zone has been out of reach for retail investors that really had no power in this. The playing field has been tilted this way since the beginning of institutional trading and the stock market, where the big money, the big institutions have all the power, and they play by their own rules. They make up the rules. They make the rules for a lot of the exchanges, and they're the ones that make billions of dollars and have the house in the Hamptons. And I think there's some truth to that, but I also think that there's really nothing illegal or wrong with a bunch of people swarming a stock and trying to pump it up to make short sellers lose money. Just like there's nothing wrong with a bunch of short sellers or an activist surrounding a stock, putting out a bunch of bad news, putting out the drumbeat to get people to sell it and drive it down. That's what makes markets. It's happening in much more extreme ways than it ever has because of a lot of the reasons I described. Easy access technology, communication over social media, people with some maybe disposable cash on their hand. We know that was happening in the early part of the pandemic, where we had a lot of folks were getting a lot of those
relief stimulus
checks.
checks.
That was going in there.
Yeah, they took their stimulus checks. Yeah.
Right. So I don't find anything illegal there. What you're going to find is there's going to be a lot of regulation and investigation to what we call payment for order flow. That's the money that your online broker gets for executing your stock trade. When you make a stock trade, I don't care if it's Fidelity, Schwab, or Robinhood, Webull, or eToro, they're not actually executing the trade. They're sending it to a market maker that is executing the trade, and they're paying for that and keeping a little bit of the money. There's a deal going on there. They're giving you best price. They're promising you best price. Nothing illegal on the surface, but regulators and the SEC chair, Gary Gensler, has said they're going to look a lot deeper into this because that's where there could be some collusion. So they're going to take a look at that. But as far as day traders swarming markets or apes swarming into stocks and holding them for dear life with diamond hands, I think it's just a natural phenomenon that happens in market manias, just more extreme this time around.
When do you think it all unravels? It's so, I feel like we're in 1999 or 98 or 97. When do you think all this mania ends?
Well, we have a saying in the investing industry, it's the greater fool theory, and it's when the last fool decides that what the price that's being offered is just not worth it anymore, and start selling. And then the herd starts following that person, right? But as long as the next person is willing to pay a higher price for the thing that you just bought, I think this is going to go on for a long time. But if you look across what's happening in the capital markets and on the outskirts of the capital markets with non-fungible tokens, right, with cryptocurrencies, even in some stocks and even in the commodities game, you're just seeing people willing to pay higher and higher prices for things that they sometimes don't understand. Now, again, that's a function of markets. You have that every time we go through one of these cycles. It's just because of where we are coming out of what we've been through, Josh, that this is just so much more extreme, happening much faster, and a lot of money pouring into this. There's a lot of liquidity out there. If you look at all the IPOs that are happening, all the SPACs that are happening and taking companies public, and all of this trading around these derivative assets, there's a lot of money pumping in there, and I think that's going to last for a long time until we hit a big economic speed bump or a big correction in the stock market, because then I think confidence will really be sapped out of investors after that.
Yeah, we saw that with March of 2020. It quickly evaporated. All the Remember January of 2020, everybody was hopeful. There were rallies being filled. I remember in New Jersey, I think that was the beginning of the end. I remember Trump had a rally in Wildwood, New Jersey. Remember, like 100,000 people went there, and that was almost like the height, the calm before the storm. And I worry that maybe we're not there now. Some have even said that this group of millennials sort of driving the markets higher could last to 2026. I think there have been certain analysts that said, they're sort of coming of age in the market, and they're just going to keep bidding prices up. So we could have like Dow 50,000. What are you seeing? I guess this will be interesting. You see what people are searching every day. I hear it on the radio. We have guests where people are worried about a crash, and they're also worried about greed. Are you seeing more fear today or greed? I guess that would be a good gauge. Yeah. What are you seeing from search results?
Sure. We have a couple of ways of looking at this, and I'm glad you asked. We have one index called the Anxiety Index, and that tracks traffic to fear-based terms. Fear-based terms around the stock market, like crash, correction, bear market, and we have fear-based terms around the economy, like depression, high unemployment. We have fear-based terms around personal finance, like bankruptcy, right? So in March of 2020, in February of 2020, and into March and through April of 2020, that thing was through the roof. We had never seen levels that high. Nobody had ever been as scared. Our readers had never been that scared, and we've been tracking them all the way back to the financial crisis. So that was the greatest fear we've ever seen, the greatest anxiety. That's come way down, and it came down fast, and it stayed down. That said, we are tracking sentiment by surveying our readers every 6 to 8 weeks on Investopedia to find out if they're bullish, bearish, neutral, what are they afraid of, what are they buying, what are they selling. And in the last couple of surveys, that sentiment has dwindled down. Even though the markets are at record highs, the sentiment has dissipated as people are fearing the impacts of higher inflation, the impacts of supply chain issues, the impacts of more government spending, more potential cyber attacks. So there's fear there, and we always get this when we get around record highs, and they are sort of as bearish as they've been, despite the fact that markets keep charging higher, and the majority are not expecting further market gains in 2022. Institutional investors had that same sentiment just a few weeks ago. They've sort of changed their tune because I think that they see an economy that is starting to fire on all cylinders, and corporate profits are pretty strong, and corporations are talking a big game about 2022. They're feeling pretty robust. Investors are usually betting on future profits, and they see those profits coming next year. So we're in an interesting place where you just don't know where it's going to go, but higher highs day after day in the stock market is a pretty good sign, Josh.
Yeah, it's interesting. I would say that's what, this summer, a lot of institutions were worried. Then we had that little 5.9% correction early October, and then it seems like institutions aren't worried anymore. I feel that from our research too. And they always say bull markets climb a wall of worry. So if everybody was optimistic, that would actually be a bad sign. So that actually tells me indicator. That's a bullish signal then, I would say, right? So interesting.
I don't disagree with you. I don't disagree with you. I mean, we do climb walls of worry all the time. And if you sold every time you were worried in the past 16 months, you missed out on one of the greatest bull markets of all time.
Yeah, definitely. So we'll be back with Caleb Silver of Investopedia.com talking about insights on estate planning and the $32 trillion wealth transfer of the baby boomers that everybody's waiting for. And folks, if you want help with your legacy, tax planning, investment strategy, call us right now for your 45-minute ultimate wealth game plan. Call us now, 888-988-JOSH, 888-988-JOSH, 888-988-5674. We'll be back after this. And we're back with Caleb Silver of Investopedia.com. So estate planning. I remember coming into the industry a little bit after, early 2000s, where they always talked about this major wealth transfer. It never really happened, right? Yet. It's happening. So as I'm seeing, there was always talk about baby boomers. We're going to be bringing in all of this money to their heirs, this huge legacy wealth transfer from the greatest generation of the boomers. But it seemed like the boomers are kind of like stuck on themselves and they're enjoying their money and they're not really transferring it to their kids like we thought of. But what are your insights on the wealth transfer? The biggest 32 trillion wealth transfer in history. Explain on that and different estate planning implications.
Yeah, I think we've all been waiting for this, and it's probably what brought a lot of us into the industry, this promise of the greatest transfer of wealth from the silent generation and baby boomers down to younger generations. Those generations, those older generations that I'm close to them, they accumulated quite a bit of wealth, whether that was through investing in real estate and owning their homes or through the stock market or other asset classes. And there's always this notion that there's about $32 trillion that they will pass down, whether that is through direct gifts to their offspring or to their family members, or through the giving of businesses or the giving of stock or other assets. So we're kind of waiting for that. And the answer to the question is it's not going to be a gush of money. It's more like a trickle that's going to happen slowly over the next few years. But this generation is getting a lot older, these older generations, and some of that estate, that wealth transfer is happening on the margins. But in general, we have some families, we have about 740 families that are worth $1 billion or more, or that earn $100 million or more every year for the past 3 years. Not that many, but that's a fair amount of billionaires that we still have in this country, and that's been growing, by the way. The estate planning that people are starting to think about, and we're really thinking about during 2020 and 21, for folks that aren't in that category, and that's most of us out there, we're not even close, is how much can they give without a tax penalty, and how creative can they get around giving so they avoid taxes and they can pass on the majority of their wealth to their kids or to their grandkids. And we're seeing that through different strategies, whether that's not foundational giving, or whether that is through direct charity giving, or defined giving, or folks using different retirement plans like the backdoor Roth IRA if you're earning over a certain amount of money, so they can keep more of the wealth that they've created and then pass it down to future generations. If you talk to financial advisors, this is one of the biggest conversations that they're having. These people have accumulated a fair amount of wealth, but do not want to get that cleaved in half as they pass it down to their generations. That's not why they work so hard for their whole life. And that's the big conversation. How do they do that in a tax-efficient way, which maximizes the gains that they've been accumulating over time, and are able to give it responsibly to the people that they've been planning to give it for, even if it's not family members, it could be charitable organizations as well.
Now, that's a great soundbite right there. Because I see people all the time as a result of the radio show who call and they're worried about the tax man almost more than even what they make. They're more concerned about what they keep. So along that line of sort of tax preservation, what have you learned as the editor-in-chief of Investopedia around taxes and estate planning that maybe surprised you?
Well, I've learned how much people care about it, because it's one of the top questions we get on our site all the time. What are my going to be my estate taxes? How do I reduce my estate taxes? How do I avoid, or how much taxes will I have to pay on the sale of capital gains, long-term gains, short-term gains? So the curiosity around this is super intense. There's a reason the financial industry is so darn interested in it. This is where the money is, and this is where they're going to create those profit margins over time. But we've also found that people can get super creative. when it comes to those strategies if they want to pass down that money to future generations and avoid a lot of those tax burdens. And those range, and you can look at some of those articles on Investopedia. There's other good sites that have that information as well. But again, they range from tax-deferred giving or charitable giving or creating pass-through entities, businesses that their children or grandchildren or relatives take over time and become shareholders in. There's all kinds of ways to do this. On the flip side, Josh, we know the government is tightening the screws around these types of loopholes, whether that is the pass-through tax loophole or whether that is a straight giving threshold. We know there was talk about a billionaire's tax or taxing people on those unrealized gains. That's never going to happen. But the notion and the drumbeat around higher taxes is getting louder and louder. And I don't think it's going to go through in this spending bill that the Biden administration is trying to push forward. But I think that higher taxes are going to become a reality eventually, just given all the spending that we're doing and the uneven wealth distribution in this country, which continues to grow day by day.
And on to the Biden tax hikes and all these things. Are any of them going to, the latest I've heard, there may be no tax hikes in light of the Tuesday elections where New Jersey was almost won for the Democrats, for the Republicans. There was a 1-point potential victory. It's still sort of being worked out. We don't know the official results yet, but apparently Murphy's up by 35,000 votes. And then Virginia was called for the Republican. That was also a close race. So I've heard from my sources, there's going to be no real tax increase. What have you heard?
Yeah, I think that the likelihood gets slimmer and slimmer by the day. But we know corporate tax rates, not the big corporate tax like they were wanting, but the 15% global tax, that's going to probably be a reality. And also the 15% tax for companies that operate outside of the U.S. but are domiciled here. We know that's going to be a reality. But raising the corporate tax rate from 21 back to 27%, probably not going to happen right now, but it could happen eventually. The personal tax rate, the income tax rate, is probably not going to go up. There was talk of that going up for people earning $400,000 or more, or couples earning $540,000 or more. That's probably not going to happen, at least not this round. But you can't avoid the fact that higher taxes are probably going to come eventually, because it doesn't. There's enough cadence around the fact that it's too easy for the wealthy to hold on to their, to avoid some taxes, even though the wealthy pay a lot of money in taxes, while folks that are earning on the lower income spectrum are still paying, almost an equivalent amount in terms of the dollar amount, percentage-wise, I should say.
Also, I don't trust the government, meaning I think we could be in for a surprise late December when, we have a compromise reached. There is going to be a 24% corporate tax and then a 39.6% marginal tax, or there's some. And here's my my historical corollary to that. If you think about it, one of the largest middle class tax hikes on wealth was done just a couple years ago with a Republican president with the death of the stretch IRA. And that's something that kind of happened at the end of the year. The stretch IRA was beloved by financial planners, accountants, financial people of both parties, of both political persuasions. And all of a sudden, boom, no more stretch. So I think there could be some weird stuff like that. Like, I wouldn't put it past politicians to kind of screw us at the end of the year, especially with the rising debt and deficit spending that, people are concerned about. They might, how did that happen under a Republican president? Well, because it wasn't really a tax hike, it was a revenue raiser. And I could see some revenue raisers toward the latter part of this year, like ending the backdoor Roth, maybe changing some estate planning gifts. Like, there's stuff that is kind of esoteric, like Ron Wyden has been talked about, and then Bernie Sanders has that for the 99% bill, where they're talking about getting rid of trust planning. Have you studied that at all? That those, like, they're going to change what you can give into a trust and grantor trusts. Have you looked into that? It can be confusing.
Well, I know that those issues are bubbling, and I can't handicap whether or not those will happen. I would also keep an eye on the mortgage interest rate deduction, which is so beloved by American homeowners and such a big deal when it comes to tax time. I don't know if that's going either, but that's another one of those that's kind of the third rail. You know, there are some of these that are super special and important, especially to taxpayers, especially those who've earned money but played the game right? They've saved their money, they invested in their home has accumulated in wealth. If they can't take that deduction, that would be a shock to a lot of people and pretty painful for a lot of Americans. But anything, I guess, is subject to, being re-examined and turned upside down by politicians on either side of the aisle. And it's really a matter of, what kind of deals they're willing to make to get their agendas passed through and who's in power to make those agendas. And we've seen that just in the last few weeks become a pretty powerful force.
Wow. So Caleb Silver, Investopedia.com, as we round out the interview, anything you'd like to plug other than Investopedia.com, projects you're working on. And thank you for a great interview.
I appreciate that, and I appreciate you having me. Well, folks, come to Investopedia.com. We always say the best day to start investing was yesterday. The next best day is today. You can learn for free how to do it on Investopedia. Just get rich in investing knowledge and learn how this whole thing works if you're not invested. And I do have a podcast I'd like to plug. It's called the Investopedia Express. Drops every Monday on all your podcast networks. We talk about what's happening in the markets and the economy, the trends, what we're hearing from our readers, but we also interview some of the smartest people we can find, and we have a lot of fun doing it. It's a 30-minute podcast tops. We don't go beyond 30, so come on in and enjoy the Investopedia Express. But really, we just invite everybody to keep learning and keep growing your knowledge about money and the way it works, because that's the best way to grow your wealth over time.
Great. So everybody go over to the Apple Store and download Investopedia Express. Is that correct? Investopedia Express?
That's right.
Okay,
That's
great.
right.
Or if you have a Google Play, Google Apps, wherever podcasts are found. Thank you so much for joining us, Caleb Silver. Folks, we'll be back after these messages. Hi, everybody. This is Josh Jelinski, the financial quarterback. And we have Dr. Richard Smith back. He's the author of the Risk Rituals newsletter, which offers investors advice on how to potentially be more successful in a risk-based world. Known as the Doctor of Uncertainty by his peers, Dr. Smith has dedicated his life to comprehending market risk and empowering traders, both new and seasoned, to be savvy investors. He also serves as the CEO of the historic research nonprofit, the Foundation for the Study of Cycles. How you doing, Dr. Richard? Good to have you on again.
It's great to be here, Josh. I'm doing great, thanks. How are you doing?
Wonderful. So Stan Harley says hello. He's with you in the world of the study of cycles.
Yes, hello, Stan. He actually emailed me this week, and looking forward to sharing some of his work with the Foundation's audience. So, hello, Stan.
Yeah, it's fantastic. So he says hi. We got to have you have a debate. We got to have you like you, McClellan, Harley. We got to have like a cycles guys roundtable. That would be fun.
I just talked to Sherman McClellan a couple days ago, actually. Yeah. So he's still going strong. Amazing.
And his son, Tom, right? Yeah,
Tom is fantastic. I'm a big fan of his work, his newsletter. He does an incredible job, really just one of the best out there.
Yeah, him and Stan are cycles guys par excellence. So
absolutely.
What we got a lot to talk about. We're going to talk about Bitcoin, NFTs, supply chain crisis. You were on here months ago talking about NFTs. Did you buy any?
I actually haven't bought any NFTs directly. I am more interested in NFTs for the future. I'm not that excited about the collectibles aspect of NFTs right now and kind of the status trade that's going on in NFTs right now. I think NFTs are really the continuation of what Bitcoin started, which is digital sovereignty, right? Being able to assign ownership to digital assets, right? So this is much bigger than just, NBA Top Shots and, Christie's.
Rich people. Rich people doing auctions. Yeah.
Right. So I think NFTs are way bigger than that. Ultimately, I'm very
So
big
you
on
aren't
the
kicking
idea
yourself.
of-
I have you on right here. So this is just how cool Dr. Smith is. You were on our show April 17th.
Okay.
And you were talking about NFTs and their viability. And
the real deal.
If we only bought the NFTs when you came on, you know, right? Have you ever thought that? I go back. I really don't have any NFTs. I think other than I sort of believe in them how you believe in them. I think there is import in the world of intellectual property, digital sovereignty, things like that. So I see the appeal. Just to me, it's like buying an NFT, you know, rare Pepe frog, like it doesn't make any sense to me. It seems like a status symbol.
I can explain it to you why those, you know, people regard them as valuable. They really are status symbols, and they're like, they make you part of a community and part of a network, right? And then they reveal your status in that network. So, you know, they do have real value to the people that are buying them. I have no doubt about that.
It's a status symbol thing.
Speaking of intellectual property, I am invested in a startup company that is using NFTs for intellectual property and for patents in particular, right? So how do you use this NFT technology to actually create, to kind of unlock value in the intellectual property and patent markets?
Yeah, that to
and
me,
really restructure those markets.
That to me is the most appealing thing with NFTs. The rest of it to me seems like a big scam.
Well, that is where I've put a little bit of my money on that bet, which is it's a private company. It's called IPWE, and doing some really interesting work and potentially, I think, creating a new economy of intellectual property using the NFT concept. So I think that's going to be much bigger than, you know, CryptoPunks and NBA Top Shots. But hey, you know, I have no beef with artists making money on their creations. I think that's fantastic. And I might not buy it, but that doesn't mean that I should become discouraging others.
But if we
involved.
only bought some CryptoPunks when you were on last show talking about how they were respectable, that would have been fun. But yeah, no, I don't really see
fun.
So the company's called IPWE.
Yes, it is, and they've got some contracts or some not contracts, but anyway, I don't want to speak out of turn.
Yeah.
A privately held company.
Sure, that's exciting.
But they're doing some really interesting work and worth checking out.
No, that's cool. So you see NFTs really for the intellectual property standpoint. What about the metaverse? I've heard different talks that people are, you know, like Decentraland and all these things. So like people are buying these $66 million paintings because that might be the world that we inhabit in the metaverse. Is there any truth to that, or is that like just what these people tell themselves?
Yeah, look, you can, you know, in the metaverse, you can create your own space, right? And if you own the NFT to that painting, right, then you can put it up on your wall in the space. The metaverse is an interesting topic. We could certainly talk about that, you know, all night long. But I do think the metaverse is a real thing. I'm not as hot on it as Mark Zuckerberg is, right? Rebranding his whole company as the metaverse company. I think he's getting a little ahead of himself. And I think if people are recognizing Zoom fatigue today, you got to wonder what metaverse fatigue might look like.
I mean, here's the thing. The metaverse has existed since the 80s when they had those group party chats, and then they evolved to AOL chat.
Yeah, right.
And we had a little debate with some friends of mine, and it was essentially like, these are really just extensions. So Meta is really going to be, you're going to be on Facebook now with Google goggles or Oculus Rift headsets. And so instead of being on Zoom, I'm going to be like, it can feel like I can touch you and maybe shake your hand, but it's really not like we're going to really inhabit another world. It's going to be like a little bit better than Zoom. You know, people don't, I think they're overhyping it. I think the import of the metaverse will be maybe business interaction. So instead of going on Zoom, you can put on your goggles and a 3D version of your guest will pop up. So you'll feel like you're really present and you can see him.
I have one example that somebody shared with me. I haven't put on a set of Oculus goggles yet, and I'm generally wary about, full immersion in the digital world. But they're sharing how they actually have meetings using their Oculus goggles, and they're playing ping pong during the meeting.
Wow.
Right. So that, I can see that that's interesting, that it adds a little value to the interaction, that, it kind of engages your mind in a little different way, almost as if you're playing ping pong, and you can have kind of some casual conversations while playing a game and almost have a little bit of, like hanging out at the gym, So anyway, it was interesting to me. But in general, yeah, I'm with you. I don't think the metaverse is everything that Zuck hopes it will be.